So Bruno is trading for a hedge fund in Europe, having perfected his Rhino strategy with Arimer, offering a service there. He does a lot of other great things, including he's done a quant series for Arimer. He's also developed SOAP, an options analysis tool, which we hope to hear more about another time, or maybe we might get a little bit about it at the end of this meeting. So with that, I will hand it over to Bruno.
Thanks, Don. Thanks for having me. Yes, I've known Tom for many years, and I've been part of Aramir for a while. I was a mentor there. Mentoring was not kind of easy because markets change, and a number of subscribers were beginners or near beginners, and I felt obliged to stick to the rules which I had taken over from Brian Larson. And even at that time, the Rhino had to evolve. And for those who have followed my presentations on Aramir, I've actually introduced an RTT mutation, etc., etc. And this time I'm going to talk about how to deal with a Rhino in a higher volatility environment. So let me start if you're okay with that. So I'm going to start with, there will be more or less three chapters here. One is what is the Rhino's prevailing principle, because something had to give in a higher volatile environment. So we have to make the Rhino evolve. I've always taught when I was a mentor at Aramir that you have to make the Rhino your own. It's an adaptable strategy, so here today I'm going to talk about how I made it evolve to a higher environment. So it will be mostly on how to deal with higher volatility, even though volatility has dropped lately, but who knows, it could actually spike up anytime soon. Today is a down day, so we can really go back to this high vol environment. And as a matter of fact, we're not exactly in a low vol, we're still above average, but we're going to look at that right now. And maybe some specificities of trading larger amounts, because I don't trade a public fund, but it's more like a prop trading firm. But I'm now trading fairly large amounts, trading a lot of butterflies. So maybe I will, towards the end of this presentation, I will talk about that. So let's go back to what the Rhino is. The Rhino is a ATM, at the money put broken butterfly strategy. Initially, it was on the Russell. These days, I traded only on SPX. There's a lot more liquidity. It's easier to trade. Anyways, I'm 100% sure that the Rhino can be traded on all indices. I'm actually now studying how to trade it on NDX, and it can also be traded on large tech stocks. But even though most of the original studies from Brian Larson was on the RUT, now today I'm only traded on SPX. So it was ATM. It was a put butterfly with the upper longs just above the money. And originally the scaling into full size was only on the upside. And the scaling in was a second batch of broken butterflies, and the hedge was typically a call calendar or set of call calendars. There has, I remember, I forgot his name now, Randy something, who tried with cold broken butterflies. That's also good. I understand that some people are not very comfortable with horizontal spreads. And basically, the management of the strategy was using put spreads, rolls, keeping your capital under check. And really what really drew me into this strategy is that it was um, really a strategy made to ensure as much as possible a flattish delta of the largest possible range. So I would say this is the essence of the Rhino, and the essence of the trade is really a flattish delta of a larger possible range. There were a few negatives about the Rhino. Um, I mean, that could be typical of many strategies. I mean, as a mentor, you're selling your stuff, you're selling your coaching classes and mentoring and everything. And what I found out is when I got subscribers is that people expected, and that's probably the legacy I got from Brian Larson at the time, that it was meant to be quasi mechanical, simple rules, strict rules. And yet, when I started trading it, I quickly realized there were, if you want a strategy to be quasi mechanical, you need to have a fully described decision tree, and there were some branches missing. So I started adding, for example, scaling in on the downside, and I believe that the training course from SMB now, I mean, or maybe another version of the Rhino. And as I said, I mean, there's no problem with having a lot of different variants as long as they make sense. So they started adding scaling in and also on the downside. And really, from the Brexit vote and then the Trump election, we've seen a new type of market with more frequent spells of runaway markets. And when the market still holds a reasonable range, you can let your delta build up over time. If the market runs away, there's no delta build up. If the market just goes way north, to the point that you can actually have your theta becoming minimal, dwindling to nothing, or even potentially turning negative. So there was no, I could feel there was something missing in those rules. So, and I also understand that some people may not be very comfortable with horizontal spreads called calendars. And another aspect to it from the original rules is that if I go back, and I mean, those presentations are public. I mean, you can go back to them. Some people would like to trade the hedge. I mean, basically, if the market runs away, you add a called calendar, for example, and then if it passes the second horn or the peak of that calendar, you just add another batch of calendars further north. And I felt a little bit uncomfortable with that, because basically you keep your original put broken butterfly maybe as a downside hedge, but it doesn't become it's no longer your main strategy. You end up trading a double calendars or calendar or double calendar strategy, and it's so different to turn from a Vega negative strategy to a Vega positive strategy. And on top of that, it's a Vega positive strategy in a runaway bullish market, and it can be tricky sometimes. So I can understand why people don't like cold calendars. But generally, I would say that you must stick to your gun, and I mean, the strategy is a put broken butterfly strategy. I mean, you can have a hedge and you can trade it to some extent. It's there to protect your strategy. But if you go back, go back to the original presentation from Brian Larson's or my initial ones on Aramir, probably 3, 4, 5 years ago, you will see that it can be difficult. It can be difficult. And personally, because I will always emphasize that it must conform with your trading style. I didn't feel at ease with trading the hedge, going from a Vega negative to a Vega positive strategy. So to me, from the Rhino, I kept what is to me the prevailing principle, which is try and keep a flattish delta over the largest possible range. When I say flattish, I would say always preferably slightly negative, because this the market goes up, but you keep it at the back of your mind that it can reverse hard on you. I mean, just remember last year when the COVID crisis just exploded, was actually worse than the Vomageddon of 2018. I mean, it helps to have that kind of experience. And I don't know in this audience whether there are new traders, more seasoned traders, experienced traders, but I would say that what I'm going to say today is, and subconsciously, the result or consequence of what happened last year. I mean, if the market goes up, yeah, it's fine. Go with the flow. That's what I'm saying here. But at the same time, keep in mind that, things may not be too rosy. I mean, if you look at the macroeconomics, the Fed, or geopolitics, I was talking to Tom earlier about what I look at in the news, and I dig for information about the growing tension with China, for example, or I don't want to point fingers at China or the Chinese people, but the CCP and what they've done in Hong Kong and et cetera, et cetera. So when the market goes up, because there are at this time so much liquidity is floating around that, okay, the market goes up, don't fight the market, but at the same time be prepared that good things come to an end, and then it can go pretty bad. So I was looking for one principle, more than a guideline, and definitely a lot more than just fixed rules, because I don't believe in rules. Same way as I don't really believe in back tests, because when people do back tests, and I remember talking on private direct messages with some of my students or even friends, I remember people saying, well, option view is going too slow, because they were just clicking day plus. They don't do their homework. I mean, you don't know what happened that particular day in terms of the environment. You just look at the shape of your trade, and basically I don't agree with that, let alone the fact that trading options is multidimensional. You have a lot of factors, and you would need a lot more history to have some statistical validity to your model. But that's another aspect to this, which is definitely beyond this presentation today. Another thing that I want to point out is that when you want to trade market neutral, delta neutral, well, actually being delta neutral doesn't really mean that you have to be market neutral. I do follow some market reading technique. If I show on the screen, for example, what I'm seeing today, I am using TradingView, and I have very few indicators. I don't believe in moving averages. I don't believe in technical indicators, except for graphical patterns, Fibonacci, channels. For example, here I saw the channel breaking. Okay, and I'm using Murray math lines. Some people may be familiar with that. For example, here we saw that the market went down and bumped on the strong resistance, tried the recovery, and then it broke, and now we're probably aiming lower. So I am using a very narrow set of market reading tools, mostly nonlinear stuff. I mean, but that's my quant side speaking now. but I am really using mirror math lines, graphical patterns, channels, and Fibonacci's, nothing else. There's no moving average whatsoever. When the market was going up and up, I also probably sometimes look at volumes, and I saw that the daily trading volumes was going low, which was probably typical of a grinding market, but that's about it. But anyway, this is not a presentation or technical analysis. What I want to say is that when you follow a delta neutral strategy, and I mean, I may state the obvious, but I mean, I've seen people who are, I would say, experienced. They've traded options for a long time, and sometimes I'm amazed to hear people talking about theta being equal to time value. No, theta in Black-Scholes, it's a formula, and theta is very much influenced by volatility. And if you are a delta neutral, if delta is your major yardstick, delta is also, as you can see here, is also affected by volatility. This is sigma here. Sigma is your implied volatility. And that's why, I mean, people use an options analysis platform like OptionView or OptionNet Explorer. And then when volatility spikes up, they see the T+0 sink, and they don't understand why. I mean, that's the volatility effect on delta. So that's why in my so-called prevailing principle or prevailing rule, I would like to keep my delta always slightly negative. Because if it's slightly negative, if volatility goes up, you will have some element of compensation. Your delta will probably go flat or even positive if volatility explodes, but you will have just a little bit more time to respond to the situation than if you are just looking at your delta and you're feeling happy, because when delta just kicks, when volatility kicks in, your delta will go flatter and eventually positive. So my first remark here would be that don't just look at delta. And something I try to put forward in my training courses, mentoring, etc., is that when you learn about options and you learn, I mean, everybody tells you, know your Greeks. And just oversimplifying a strategy around delta is misleading. Basically, we are, as a market neutral trader, when you try and keep your delta flattish, volatility becomes your main concern. That's why they say, well, you must enter on a vol pop or whatever. But volatility is really the most important. Vega may be actually a lot more important than delta. In low volatility, so when I say keep your delta negative, I mean, you can also look at your delta. I mean, that's what I call here the D over V hedge. If you, I mean, I remember 2017, you know, this market going one way, and lately it looked like we were going in the same direction. Not only keep your delta slightly negative, but maybe look also at your delta over Vega. In low vol, I would say that a 10% ratio is safe. Maybe in a higher volatility, you don't need to keep that type of ratio. You can be maybe 5%, maybe 2-3%. It also depends on your trading style and whether you are conservative or not. Now that I trade for a prop trading firm, I feel a lot of responsibility on my shoulders. So I will probably keep delta negative because I think we have to be careful, but I will come back to that later. And if you have a not a retail platform, but something a little bit more extensive, a little bit more sophisticated, I would say check Varna. Varna is also called the D delta D vol. So that will also give you a measure of how your delta will be impacted by volatility. The reference is here. And as you mentioned, Don, I mean, yeah, it's part of SOAP calculates that. I wish the retail platforms would, now that we've had in 2018 the Vomageddon, I mean, why don't we see Voma? Why don't we see Vanna? I mean, okay, that may sound like it's a more sophisticated or complicated issue, but if at least most traders would know their four basic Greeks, delta, theta, gamma. Yeah, gamma is important to me, but okay, this may not be the most important, but Vega is. Okay, so so another thing that is important is what I call the homework. What I found out, and that made me very uncomfortable when I was a mentor, is that people just, I mean, okay, well, they were sold a quasi-mechanical trade, so okay, I don't blame them, but markets are difficult. You need to do your homework. I mean, I do my analysis of economics news, and I check my market outlook, and I check for salient support and resistances. I check my Greeks 1SD, 2SD projections of a 1 day or two of a 1 week. Another thing that is maybe important, and we'll come back a little bit more in detail later, is know your basic, sometimes I call them Lego blocks, your spreads, your flies, because that will dictate what you're going to be playing with when it comes to adjustments. I mean, a lot of people don't actually pay much attention to a PCS or a CCS, and especially now that I'm using more the call side, you must know what actually affects your call credit spreads, for example. Of course, you must start with a small set you're very comfortable with, and as you grow with experience, you will have a bigger set of Legos. Another thing that is important, has been important in a bullish market lately, is that you must learn to decompose your trade. When I say that is that when you have, let me, for example, show you one of its current trades. Let me show you, for example, my June trade. I mean, it's not doing great at the moment, but it's okay. This is my June trade. Okay, this is my June trade today. For example, I will check my bottom. I mean, I entered with this broken butterfly. I will, now and then, I will check. I will just look, for example, I mean, if I cancel this broken butterfly, so for example, -3, 6, -3. I mean, it's just for interest's sake. You see, my theta decreases. That means that this combo still provides some positive theta. But sometimes when the market runs away, if you have a part of your strategy that is theta negative, it's almost as bad as your whole trade turning theta negative. So do not, I mean, you have to analyze your combo completely, not just the whole thing. And of course, I understand that, again, for marketing purposes, a lot of mentors want to simplify things, but I would say check every part of your trade. And be consistent. Consistency comes with experience, of course, but what I see sometimes is people becoming too emotional. I don't know, the market reverses, then they were too aggressive. If you're conservative, if you keep some negative delta, really you have time to think, you have time to reflect, and you have time to adjust. And maybe because I'm now older and more mature, I mean, I don't have any problem with that. I mean, I have time to do whatever I need to do. Another thing that was not part of the original guidelines, and that became very important in my trading style, is to look at the trade in three phases. Um, I used in the past the flying metaphor, but so let's say the first part is taking off, build up. When you inject capital into a new trade, I start around 77 DTE, and that can be until 56 to 49 DTE, so 8 to 7 weeks. This at that time the trade is very resilient. If you and if it's resilient, it means that if you go wrong, you can still roll back at zero cost or little cost. So that also addresses a problem of what in marketing is called cognitive dissonance. The oops, I shouldn't have done that. During the first 2 to 3 weeks, you can still, change your trade. You close whatever you have, or you roll back and you reposition. That doesn't cost you anything or very little. The important part is the cruising altitude. And I can understand that some people would say, well, then if nothing happens in the first 3 weeks, why entering this early? I mean, okay, that's a choice. I mean, that's my choice. I mean, you don't have to follow that. It's not essential, but it has some meaning to me. We'll come back to that a bit later. The market, the trade becomes a little bit more sensitive to turbulences in cruising altitude. That's also where you shape up your trade to basically at the end of takeoff. I probably know already whether it's going to be a good cycle, a good month or not. But when you reach that second phase of cruising altitude, you should have put on your full capital or near full. At this time, and I haven't changed that from the original rules, I still use up to 25K Reg T capital per cycle. So if you can get to 18, 20, maybe, I mean, if you're more aggressive or you want to put more capital at play, you can go up to 25K. That's going to be your maximum for that cycle. At the same time, the trade is becoming a little bit more sensitive. I'm not saying your gamma starts playing up, but you need to get your things right by then, and that's also a reason why it makes sense to grow into the trade. I mean, get slowly into the trade, into cruising altitude. The last part, the descent, after 28 DTE up to 14 DTE or up to closing, is the descent, approach, and landing. At that time, I personally choose to reduce capital. Some people would say, well, that's where you get your most theta. Yes, but with theta comes gamma. I mean, whatever you say, it's a very simple, straightforward relationship between gamma and theta. And if you have gamma and you don't hold your delta balanced, your gamma could I mean, if the market is not stable, your trade can go haywire. So that's why I would rather forfeit theta, but I reduce capital, and I reduce capital generally in the same consistent way. But I can explain, but on this presentation, there are not many screenshots, but maybe in a later one, I can do that. Another thing that is important to me is as I move capital from one cycle to the next, I rebalance my Greeks. I mean, it's why wouldn't I do that? I mean, it just makes sense. It's just common sense to me. So every time I add capital or reduce capital, I look at, okay, my prevailing rule, which is flattish delta of the largest possible range. And when I say that, I sound like I'm oversimplifying again. No, it's not only delta. I look at everything and rebalance my Greeks, knowing that capital reduction will reduce my gamma, but will also reduce my theta. I mean, that's something I accept. I live with, no problem. So what I'm presenting today is my trading style, and it's fairly conservative, for the main reason that I'm trading a fairly large amount, and I feel that responsibility on my shoulders. I feel that I am trading more conservatively than I would do it for myself. But also, the thing is that markets have changed enormously. From when the Rhino first came around, I think 2015, with Brian Larson doing his quick and whatever back test from 2013 to 2015. I mean, look back. I mean, the markets was very, very different. Then as I said, from Brexit and the Trump vote, market went runaway bullish. So we had to change the rules, but also I realized that we had to make the trade evolve, make the trade change. So because it's a trade-off, you have to accept that it's a give and take. So, okay, controlling my gamma by pulling capital out of a cycle when it should be producing most towards the end of the trade. I mean, don't be too greedy. I mean, okay, I lose some theta. I may lose in terms of potential profit, but that's okay. I'm looking more at a smooth way of making money. And let's not forget that also now that in euros, interest rates are negative. In the US, they are basically zero. So the reason why I'm trading for a prop trading firm is that there are lots of liquidities looking for a conservative trading system, a strategy that can yield. At the moment, I'm making about 1.5 to 2% every month, and I'm trying my best to keep it that way. I mean, but for people who keep the money at the bank for a few percent, or you can have some, fixed deposits for maybe 1 or 2%. But I mean, you can make people happy if you can provide 15% per annum. That's so. I think by setting unrealistic objectives, not only you will lose in credibility, but really, and if you're a trader and you want to raise capital, a lot of people are happy with 15% per year, easily. So I've decided to reduce my profit targets, but at least I generally reach them. Another thing that you need to put into consideration is that, because when I started talking to Don about this, and maybe when I started talking on Aramir, was it a month ago or 2 months ago, we were in high vol bullish market. Now volatility has dropped. Okay, things do change when volatility drops. The faces when I just said, well, like 49 DT up to 49 DT for the takeoff phase, maybe now it's going to be 42. The cruising altitude, okay. I mean, because if you're conservative and volatility drops, meaning that there are fewer opportunities to adjust effectively, maybe give yourself more time. So, and in the last few months, I had to take trades to expiration, with due regard that taking a trade to expiration is not something beginners should do. But if you do it well, I mean, you still keep your risk under control. And as I said before, check individual combo contributions. like as I showed you in my June trade. Of course, the June trade is still early, but late in the trade, if my bottom combo doesn't produce anything that is negative, I'm going to drop it. And then if I reduce capital in that trade, that will mean more capital to put on the later cycle. The question I asked myself, and I don't have an answer for this, is that is this a momentary deviation from so-called normalcy, or is this a permanent mutation of the rhino? What I can say is that at least the rhino, and unlike some other strategies, I'm not going to name anyone, that have fallen by the wayside because they were too strict, they were too contained into fixed rules. At least this rhino, if you follow this evolution, you can actually make it adapt to this new volatile environment, to this bullish market environment. Yes, that may force you to develop some mild form of schizophrenia. Go with the flow. I mean, don't fight the market. I said that earlier, and I will repeat it over and over. But yes, this conservative stance is that, and also because of the memory of 2018, and that was really it was really tough last year. Market reversals can be painful. So I hope you get my thinking, the way I think about trading, because that's quite important to me. So the second point is high volatility. Generally, high volatility is good. I mean, high volatility, you get very effective adjustments. You get your trades at a better price. I mean, that's good. Nothing was worse than 2017 when volatility was so low. And when I lost money on some cycles at the time, some were mistakes, which I have understood now. But also, it's also sometimes understanding that you just be better off doing nothing. If volatility is too, it does. I mean, as I said again, you sell more Vega than you, and Vega becomes so much more important when you're delta neutral. So high volatility makes trading fairly easy. I wouldn't say that this is the answer to everything. This is not the magic number 42 in the Hitchhiker's Guide to whatever. No, I mean, there's a limit. There's definitely a limit. But at least I would say that the Rhino has done pretty well, providing that you drop tight rules. Because if you want to follow a strict rule system, I mean, you will fail. I mean, there's no doubt about that. And what I came up with is that in high volatility, larger Brockwing butterfly wing sizes helped me a lot. But that's not the only thing. I also chose. I mean, it's not that I chose. Is that because I wanted to conform my ruling principle? I checked, of course, what would be a standard entry, and the standard entry always gave me a positive delta in high volatility. And I don't want to start with a positive delta. I understand that that's something RTT traders can live with. That's not me. That's not what the Rhino was supposed to be in the very beginning. So I decided, no, I am going to go for larger wing sizes, and I'm going to move my entry OTM. So because we're talking about puts, south of the money, south of the market, until I have a combo that gives me a negative delta and gives me something I'm comfortable with. And of course, and I come back to what I said earlier about keeping at least the four Greeks in mind, I understand that there may not be any precise rule. And I understand that there's always a trade-off. What you gain in some way, you lose somewhere else. Um, what, this is the right slide. Well, I suppose it is. At least one good thing is that if you trade OTM, there's generally good volatility out of the money. So you're not really looking for the vol pop that you would go for if you trade ATM. And by the way, if you know your modeling, your Greeks and everything, there's a lot more than just a vol pop. Pricing, generally, you pay for being under the tent, all the things being equal. So sometimes you see on the market moving bullish that the price of your broken butterfly becomes more attractive. And it's going to be even more attractive in times of sticky vol. So you've had a little bit of a vol pop, and then the market bounces off a little bit. Volatility stays high. So basically, and I could go back to that slide earlier when I said do your, actually I can quickly, because that's actually quite an important part of, so this is the slide number 13. That's something that I probably glanced too quickly, is that part of my homework is that I check my SPX VIX correlation. At the moment, I mean, I did that copy paste a few days ago, but at the moment, SPX VIX correlation is pretty good. The anti-correlation is pretty good. But sometimes you have the market going up with volatility going up. And that's bingo. That's really when you will get a very good entry. But I would say that when you price your entry, sometimes when the market goes up, you will get a better price, regardless of volatility. And if you have high vol on a grinding up market, that's even better. Okay, I was talking about trade-offs. Yes, if your combo is far OTM, the PDS side of your broken butterfly will be less powerful. It will protect you less against on the downside. Yeah, that's fine. But I mean, at least if you accept that, that's fine. Don't expect everything to go kosher and rosy. And in the bull market, your PDS, the PS side will even phase quicker. I mean, you may end up like I showed. I can even show you my let's say my May trade, which is not doing great in this. But let's not forget that market went up by, I don't know, 300 points in 2 to 3 weeks. So I'm not unhappy about this one. But I know that, let's forget about this PCS here, but I know that this PDS here is producing nothing. It's way too far to be of any importance. So in my next adjustments, which mostly because we know our 31 DT will be trade reduction, so I'm going to reduce probably the lower side of the trade. But I know that I could end up with a unbalanced condor, and it's going to be just the same. In other words, I'm probably keeping this PDS to have some money to capture when I actually close it. An OTM PDS is virtually irrelevant. Anyway, let's go back to, no, where is that? Yeah, right. Another thing that is quite important, and that's part of the trade-offs, is that when you trade OTM, your theta is reduced. Theta being reduced, and that's what I said earlier, the trade phases or transitions are delayed. So when volatility goes down, you must be prepared to go slower with your trade. And that's why, as now, there was quite a big transition. February, March, we were in high vol. April, I still did okay. but I made about 2%. But yes, there was a transition, and now June to me is in good shape because the market fall has been now discounted. But yes, when the trade transitions have forced me in the last few months to go to expiration. Not that I like it, but I'm not uncomfortable with that either. Another thing also is that if you remember the original rules, when you start ATM and the market goes up, you're supposed to scale into full size when the market goes up by 1%. So of course, if you are already entering OTM, there's no scaling in rule. I mean, it doesn't make any sense anymore. So I've replaced that by what I call add-ons, common sense add-ons. And the first add-on you must think of is another put broken butterfly. Of course, you can use credit spreads, you can use iron condors, but as you grow with experience with a particular combo, and that's why the Rhino is still very much a put broken butterfly type of strategy. The first thing you must look at is, I'm going to add more put broken butterflies. Now, the put broken butterflies I'm going to add on may be the same ones as per the original guidelines. And I would suggest that you keep the same size, again, as per the original guidelines. If you put on add-ons early and volatility stays roughly constant. As time goes by and if volatility drops, you will start reducing wing sizes. If volatility goes up, you will increase wing sizes. And that is probably the most important part of this presentation today. So you will be comfortable with, in a given volatility environment, with one standard size wings for your put broken butterfly. And as time goes by, and like now when volatility goes down, I add capital later than I would normally do. But because time goes by, volatility may go down, I will put on narrower put broken butterflies. So it's either or both. So you start with a standard size you're comfortable with, and you start reducing as time goes by, or if volatility goes down. That's what I just said. So if volatility comes back, you will return to regular wing sizes. Return to regular sizes. No. Sorry, I think I made a mistake here. Anyway, what I just said is more important. If you start in a higher volatility, you will probably start with higher wing sizes, larger wing sizes. And as time goes by and you're late into scaling into full size, you will probably add narrower put broken butterflies. If volatility goes down, you will also go narrower. If volatility goes up, you will go back to normal sizes or even wider sizes. Something that I've used more lately is iron condors, because they give a good theta. And let's not forget that if you start OTM and you already suffer from lower theta, an iron condor can actually really boost your trade. And I understand, same as call calendars can be tricky, but some people generally don't like going on the call side. They trade on the put side, they do PCS on the upper longs, what has been now called a reverse Harvey, or other type of put grade spreads. But really, It's all right going on a call side as long as you are careful. And as I said, if volatility picks up, you will go back to your standard rules. If volatility goes back to, I would say, average, let's say 40, VIX around 14, 15, which is its long-term average, I will probably shift back to the way I was trading a few years ago. Assess whether the adjustment conforms the ruling principle and do not overtrade. What is quite important is that capital allocation or reallocation to me is not overtrading. It's trade management. You give up a little bit of theta because you know that late in the trade there could be more theta. You give up theta, but you're also more conservative on the gamma side. So shifting capital from one cycle to the next, to me, is not equivalent to overtrading. So whatever you do, conforming that ongoing capital reallocation is fine. That's not overtrading to me. So if you trade on a call side, and also because I am conservative in nature, I check my IV skew. I can't remember when I got a screenshot, but I think that was April. This is May and June. As time goes by, the trough in the vol skew goes closer to the money. So if you start on a call side, you will try and put your call credit spread north of the skew, providing the skew as formed. So it's generally not recommended unless you take a speculative bet you have to deal with. If you put on a credit spread, unless you have a strong conviction of a reversal, then there's no problem putting your call credit spread south of the trough. Otherwise, to be safe, you should be north of the trough. So this is May, and when I took the screenshot, the trough for May, which is the red line, was around 4,300. I've rolled my call credit spread on May since. I mean, it's just May, and now my call credit spread is on 43.75. So I keep it safe. I accept that I have lost a little bit of profit potential, and it's not going to be a great month. If I make 1.5%, I'll be happy. But at least that's one way of dealing with calls. Because if you look for a general trade-wise delta, you may forego or ignore what's going on your call side. I mean, your trade looks about okay, but again, decompose your trade and look at what's going wrong in your trade. And I would say if the market goes up, this lines will shift left. And if, for example, now I've got my short around here and my long a little bit above, it's still okay because the short volatility is low and then my long volatility. So my CCS is holding well. If it goes this way, well, your short side the volatility will go much higher and your CCS will go berserk. So that's why I would say check your vol skew and make sure that your CCS is north of the skew. That being said, in lower volatility, the vol skew forms later. So generally don't go too quickly on the call side unless you accept that kind of speculative bet on where the market is going to bump on a strong resistance or whatever. But you may have to be careful. The time value from going early is probably not worth it. So keep it north of this convexity here. If now you want to go horizontal, so I'm going back to original guidelines, and to be honest, I haven't used the call calendar for a long time. Not only because in a runaway market, my delta didn't build up enough to get to some kind of alert level. And I remember some student telling me, well, why don't we reduce the alert level on the upside? Yeah, that's quite possible. It's something that is worth looking at. But generally, calendars do well in backwardation. They do well if your horizontal skew is negative or flat. So you check your horizontal skew, so basically the implied volatility on various um, expiries, and if you have your skew that is next to zero, sometimes negative, then your call calendars will do well. But call calendars can be more tricky than put calendars on the downside. But so this would be fairly good entries for call calendars. And I'm not saying that the delta alert was good at the time. I didn't check. But if your short-term volatility is low and the market goes up, your calendar will not, your call calendar will not behave well. I mean, it's going to be horrendous. So check your results queue if you want to trade or results queues. And it could be calendars, but it could also be diagonals. So another aside, because as I said, we've got that painful memory of last year. Excuse me. So I would say that if you use in a high vol this type of approach, and providing that you always keep some delta negative and your delta vega is okay, and I'm not saying it's a rule, a one size fits all rule, because again, a trade will behave differently in its different phases, but generally with some negative delta and an OTM entry, you have more time. So the stress level is next to nothing. The one thing you always have to keep in mind is reduce exposure, reduce capital on the cycles which are the most sensitive when the market drops rapidly. Something that which I used quite effectively last year, and I called it the roll in one go, is that when you roll back, I used that +1 -2 +2 -1. Can't remember with TOS, but with IB, whatever combo you build can only be made of 4 legs. So basically, it's a inner PDS, so inside an outer PCS, and generally, and I don't pay much attention about price. You know, I when I need to do it, I do it. So basically, that +2 -1 times, of course, the number of broken butterflies you want to roll back. It's the upper side of a put broken butterfly that you are getting rid of, and you're just placing it below with a +1 -2. But, and I'm not saying that this is any rule or guideline. I mean, sometimes it works, sometimes it doesn't. But I would say that common sense again is that protect your tent, flatten your delta, and in the enormous fall that we had last year, I did okay on the downside. Of course, I had a drawdown. I mean, volatility went through the roof, and actually, I struggled more on the whipsaw when the market shot up again after that. But on the downside, it went okay besides the drawdown. So just think, I mean, keep that at the back of your mind, back test it if you will, but that's something you can look at. And if you see this happening, put calendars at least do behave better than call calendars. So sometimes I do put on a put calendar below my shortest puts. And there again, to come back to what I said earlier, I don't really trade the hedge. I mean, it's a put calendar. It reduces my negative vega, and generally it's going okay. Nowadays, trading larger amounts, and of course, you need to keep things a lot more simpler. I put on a buyback on a short put on a conditional order. I always have one on. So, for example, the market would drop below 3,600 in a day. I buy back a put, and that's it. I buy back some negative delta, and of course, you need to figure out when the market drops where the delta would be. But it's not rocket science. It's actually fairly easy to do. Another thing that is linked to professional trading is that I do have to check open interest. I put on a screenshot here, and we see the open interest on certain strikes. I remember presenting on the Rhino a while back, and people said, well, I mean, you can go 5 strikes, 10 strikes, and there's liquidity. No, I mean, if you trade large amounts, I do stick to multiples of 50 or 100. I mean, that's where the liquidity is. That's where the big boys are. So okay, I mean, if you trade one put broken butterfly here or there, I mean, I remember whatever technique or algorithm to check what is the optimal size of your wing sizes of your put broken. Okay, fine. I mean, but I don't look at 5 strikes. I hardly look at 10 strikes. 25, yes, and mostly 50 and 100. That makes me trade balance fly sometimes. So, and I will, if I, because there's no strict rule where you actually place your OTM put broken the fly, as I said earlier, but I will naturally go for example, a 3,600, 3,700, and 3,800 balance fly, and then add a PCS on my upper puts. That's, and sometimes liquidity is bad. And so basically, when you trade, you must favor vertical. Doesn't It's not always easy to decompose your flies into PCS and PDS because it can be difficult. If the market moves against you, you can lose. And so I would say generally, if you can't get a fill on your broken butterfly, go for balance fly and then sell a PCS. If you're more aggressive, of course, or you trust that in the next 5, 10, or 15 minutes, the market will go in one direction. Of course, if the market goes down, buy your PDS, let the market fall and sell your PCS. That can be fine, but you're taking a chance. Another thing on the professional trading side is that placing your trade OTM, knowing that your PM margin will check not, of course, volatility, but also where SPX, because I trade mostly on SPX, the minus 12% level. If you are OTM, you are naturally more protected on the downside. So this has helped me to gear up a little bit. I'm actually trading at 1.3, 1.5, the number of tranches that I would normally on Reg T. So when you see on my here, I mean, this is Reg T because this is still my benchmark, but my account will be, so on Reg T on this one, I'll probably make 1.5%, but I am gearing up 1.3 to 1.5 times that. So we'll still make my 2% this month, I assume. I mean, of course, I don't have a crystal ball, but that's more or less what I'm looking at. Also, when you trade for a professional institution, your benchmark is your NAV, your net asset value. So I can't afford to have wide variations of my pricing. And that's something that is linked to professional trading. If you are a retail trader, it may not be that important, but I can't afford to lose too much on a weekly or monthly basis. Make or lose. I mean, my equity line is quite important. And also by reallocating capital, it's pretty smooth overall. Okay, so I'm coming to the end of this. So the major changes is that broken butterfly wing sizes are now becoming a lot more volatility dependent. My rule of thumb, because of course this episode we've had is something new, high vol, bullish market. So as I said earlier, I check my correlation on the VIX and SPX VIX. If VIX is above the third quartile, at the moment it's about 19.5, I use larger wing sizes. Normal volatility, so in between the first and third quartile, my normal or standard wing size is 100/75. In low vol, something I didn't do at the time, but I regret, and I would do if we ever go back into crazy low vol, I would reduce wing sizes, 75/50. And I checked back in history, and I would have probably saved a lot of money if I had done that at the time. In terms of consistency in your trading strategy, keep your PCS to PDS wing ratio around 1.2. 125 to 100 is 1.25, but I mean, I'm not saying that it is a important rule, but if you change that ratio, your trade, your combo may behave differently, and you may find it something new. I mean, okay, you can learn, but it's also good, especially when we're talking about an evolving Rhino strategy. You still need to have things you can count on as being stable. And for example, I said earlier that in high vol, I would go larger wing sizes, or I would go OTM. Nothing prevents you from staying closer to the money and going even higher wing sizes. Nothing stops you from going 150/125 or 200/150. But I would reckon it's important to keep your wing size ratio fairly constant. As you notice here is that I kept my difference between wing sizes stable. So at least my capital usage remains the same. So that's something I don't have to worry about. So if I usually use 3 broken butterflies for standard entry, it's higher vol, I'm going larger wing sizes, it's going to be the same. In terms of margin, it's still the same because the difference is still 25 and 25. So that's a lot simpler that way. Wider wing broken butterflies are generally a lot more expensive, but that's something you can afford when volatility is high. I could get, and of course, I could be tempted to go standard size because then you have a positive line, upper line from day one, but that comes with a positive delta, which I don't want. My principal rule is still keep your delta flat to negative. So because higher vol mean you can afford wider wing broken butterflies. They're generally more expensive, but in high vol, they are very cheap. I mean, I invite you to backtest and you will see that they do very, very well. And also your PCS to PDS ratio will be slightly lower, which means your PDS will be more powerful. So here, I'm not giving any strict rule about OTM positioning or wing sizes. It's up to you. I mean, I also use my market reading ability to look at where the option interest is and the and strong support from recent lows. So, I mean, to me that's only common sense. Another thing also is if you use the call side, you will see that your Vega risk will be better spread. Of course, if you add CCS to put broken butterflies, we shouldn't fool ourselves. I mean, it's still a more Vega negative strategy position. You add Vega to Vega, but overall, that's why in my trading management, something I haven't had time to get into, is that when I do reallocate capital, I sometimes also do a little bit of risk reversal here or there. But that's something I won't get into right now. Maybe I'll do a more detailed presentation on Aeromere soon. So is this a generic broken butterfly trade? No. I mean, this is a generic broken butterfly trade within that key principle. That's all what it is. The good thing is that I've found that by adding this to my tool set, I've made the Rhino a lot more adaptable. And again, I'm not going to be naming other strategies which have not fared too well lately. But really, if you try out what I've just said, I mean, you will see that you will make your Rhino trade more powerful, more diverse, more versatile. So, of course, I can only speak for myself with my level of experience and knowledge and maybe my quant side to it. But anyway, to me, it's still pretty simple. So at least the good thing is that what I've just presented to you today it's not specific to the Rhino. I mean, if you have a X4, whatever, or the broken butterfly strategy, you can still apply going more OTM and going wider wings. Even the RTT or whatever. I mean, it's something that is pretty much general to trading broken butterflies. Okay, so conclusion. I think we've exceeded 1 hour and have another commitment soon. So of course, always adapt to your trading style. That's what I've been doing now, and which I've been explaining today. It's not specific to the Rhino. I am conservative. I mean, if you are more aggressive, you will not necessarily take the same steps that I've done. But all I can say is that they have this type of adaptations have done pretty well lately. Anyway, I'm going to stop here. So again, keep learning and thank you for listening today.
Fantastic, Bruno. Thank you so much. Now you have to run, is that right?
Yes, I'm actually late, but that's okay. So if there are a few questions, that's fine.
Okay, so one or two broad questions I think Bruno is saying he has time for. Probably best to use the mic if you have it. Are there any? Or do we want to let Bruno go and continue discussion among ourselves? Anything you need for Bruno? Anybody? Well, we look forward to the resumption, Bruno, and another talk, maybe on soap, another time.
Okay.
If you've got a commitment, why don't you go and we'll continue with some discussion among ourselves.
Okay, that's fine with me.
Thank you very much. We really,
thanks to you.
Fantastic talk. That's the kind of talk we need, where we have not only just the specifics, which there was plenty of, but also general principles of trading. And a lot of it really does apply to any income spread. And so it's a tremendous education for many of us. Thank you again.
I'm happy to help. And I remember attending to one of your recent presentations, and I've got nothing to sell. I'm just happy to share. And one thing also is that I've got my own Slack. It's bwbflies.slack.com, specifically on the Rhino. So if
bwbflies.slack.com. So I'll join that if I'm not already on it, and I'll post on our forum. People can check our forum for where I'll retype that for people who need it.
Okay,
And
cool.
may we share your slides? You already sent me a draft copy. May I share that?
Sure. I will. Just there are just a few typos changing. I mean, I will send you the
Sure.
version I used tonight.
Thank you so much once again, Bruno.
Okay. Thank you very much, and speak soon.
Thank you.
Bye.
Bye. And we'll continue. Who has some comments? First of all, let me ask, who has traded the Rhino? Is there anyone here who has traded the Rhino? Juan, you have. Do you have a mic, Juan?
Yes, I do.
Good. What has been your experience with the Rhino?
Well, actually, it's good. I haven't traded a lot because I just started trading at the end of last year, like in December, because I was learning it. So it's not much time, and the volatility. I was not in the high volatility environment. So starting in January, the volatility start coming down. So it's
Yeah.
been here, I think. So I haven't tested when in like Bruno was saying, 2020 the volatility jump, well, since 2017 actually. So I didn't trade it at that time, so I was probably didn't have probably will have more problems with the volatility spiking, because since January the volatility have been stable and actually going down.
Yeah.
So I haven't had any problems. I haven't collected my money. I was just following the rules actually. And no, I didn't have any troubles. And I don't know if you guys have been trading more than I do the Rhino trade.
Did you see anything in the talk that surprised you or that was different from your understanding of the Rhino?
A couple of, not surprising, but I was guessing about the vola, because one of the things about the trading, about the Rhino trading was when I was learning it, I was in my mind was thinking about volatility, because when that trade came in 2015, 2016, the volatility was not high. So I was thinking about it. But what happened in 2020, how the trade will go in 2020 when the volatility was really high, and we have that measure since COVID. In March, the market went down 30% and then right up in the next following month. So I was thinking how it will affect the strategy, the volatility, and I was thinking, Bruno, everybody, well, Tasty Trade suggested the more volatility you can, in the case of the butterfly, you can open the wings. So I was thinking maybe it's more money and you can open the wings. I will say a little safer. So I was in my mind what happened when the volatility was high, because at the moment the trade was created, I guess, the volatility was low. So he seems that Brian, I believe, the one that started created trade, he didn't mention often the volatility. So I was always in my mind wondering what happened when the volatility was high, or actually, like Bruno said, when it's really low, below 12, when it's really, really low, how will you how you do process, how do you will actually take on consideration the volatility in order to make your trade. And I think that he said pretty clear, when the volatility is high, about 19.5, you can open the wings. When the volatility is between 12.5 and 19.5, I believe he said, regular Rhino wings, and when it's below 12.5, I believe you should short the wings. So I think that's pretty important when you want to apply this trade.
Okay, I've lost the sound.
Because I finished talking.
Okay, there we go. I'm sorry, Juan, I lost the sound for a moment. But now, is it true that you would expect this trade to make money if volatility does drop? In other words, for existing positions, would you expect to make money if the volatility does drop?
Well, that's a good question. Right now, because the volatility is kind of flat right now, I believe it's around 16, 17, the VIX. I expect to make money, but I don't know if the volatility keeps dropping like all the way to 12.5. I believe he says it will be like really low. Then maybe, probably, maybe in trouble. I'm not sure. It doesn't happen yet. But the thing about the volatility, usually when it drops slow. When it spikes, it spikes really fast, really high, like in 2020. But when it's going down, usually the volatility kind of drops slowly, like it happened in January. Slowly was in the 20s, upper 20s, and slowly going down. Now is in around 16, 17%. So usually gives you time to see what's going on to make a decision to maybe stop the trade or not. But I haven't experienced with volatility below, really low, like he says, below 12.5. So I haven't that experience to see what will happen if the volatility drops
Sure,
severely.
sure. Who else has some comments on the presentation or on this kind of trade in general? I see
Hey,
we
Don,
lost some.
this
Oh,
is
go
Ryan.
ahead.
How you doing?
Yeah, thank you, Ryan.
I thought it was an excellent presentation. I really liked how he went into such detail about volatility and the adjustments that he's had to make, as well as how skew can affect trade. And I especially liked some of his downside adjustments. I thought they're really interesting ideas that I had not heard. Some of them I had not heard before. Um, And then, of course, I've always been a fan of the 25-point strike. So to actually see the graph there of the open interest was pretty cool.
Yeah, I mean, these are the things we keep seeing. It's pretty difficult to talk, to know. He has the different months, the different expiries, the time evolution of the volatility and of the skew in particular. And he says, here are some pros and cons to putting it below the market, to putting or below the trough. And here are some pros and cons to putting it above the trough. And these are all levers that are there that really, to trade any spread, any butterfly spread, we have to try and get a handle on. And I think few of us are completely comfortable that, or even have any idea. Well, do I place it below the trough, above the trough? How will it affect different wings? Also, his concept of that you have to keep all the components making a positive contribution is pretty interesting, or at least doing of some kind of contribution.
Yeah,
Are,
yeah, I second that. I mean, what Ryan says is pretty good. Well, what Bruno said, and Ryan was just talking about. Yeah, the open interest, for example, I was following very mechanically, just like as they say we should do it. So, but Bruno also talks about don't see it as like a two-dimension, make it, as he said, option is multidimensional. So you have to put in considerations the VIX and of course all the Greeks, because pretty much I was just following the rules with the delta and the theta. So I was doing mostly mechanically, and I was not putting a lot of other factors like open interest go to he says within to the 50s and the 100s because there's more volume, therefore better liquidity. So I was not considering that. So they also put that on my mind to consider not just the mechanical part of the trade, but see the overall environment in the market and see all the Greeks and all the open interest and all the skews and all that extra that you should put to make it more profitable and more safer your trade.
Yeah, I thought another interesting aspect was ways in which he has changed his trading now that he's doing it professionally. And one of them was keeping the account balance mark to market reasonable, which he calls, I forget, account value in one form or another. And the other was along the same lines. I think that improves the trade overall, and we all need to do it. Who else has any comments? Or Ryan, do you have further comments?
No, that was mainly it. So yeah, I appreciated that he just done a tremendous amount of experimentation, and it was interesting. You can just tell that his experience level at the prop trading firm and all the different angles that he's analyzed this trade. It really comes through in his analysis and vocabulary and the way he talked about and presented his slides today.
And it's, he said he has nothing to sell, and that's very, very true. He's really has a philanthropic element to everything he does. Of course, he has his soap product, but he's giving it away, been giving it away since the beginning. And he says he won't have time to commercialize it for another year, probably. So it's free, and we have another talk on that. What do we want to do with the remaining time? Do we want to keep going, or do you want to bring up anything else? Ryan, what is your suggestion on that?
Well, I don't really have anything more. Is there anybody else that has questions?
Yeah, do some people have some questions that they would like clarifications on? Does anyone else have anything they'd like to bring up? Anything to do with trading? Doesn't even have to be on this topic.